All right. So now we are going to talk about the double entry bookkeeping for expenses and income. So expenses, whenever you're having an expense, you debit it. And whenever you're earning income, you're going to credit it. Okay. Let's talk about some of the examples of expenses. So the examples of expenses can be rent, insurance, electricity, and sometimes we have irrecoverable debts. Irrecoverable debts means, these are the people who are our receivables, but they are not paying us. Okay? Either, they went bankrupt, went out of the country, or uh, they just simply refuse to pay because, they are not satisfied with the services, or they say that, the products are damaged or something. Okay. So this is also an expense. And what else? Salaries, wages. Depreciation is an expense. Depreciation, we charge depreciation for our non-current assets. We are going to talk about it in detail. We are going to talk about the irrecoverable debts in detail uh, in a topic, and about the depreciation in detail in a topic as well. But to be precise, depreciation is we charge it to our non-current assets. So that's also an expense. Okay. Whenever our expense increases, we debit it. Okay. Income. Income is like, let's say rent received. So we have a premises, we are a factory and we are producing some products and we are selling it, and we have this extra building, so we just rent it out. Okay. So we are receiving rent from this building. So that would be rent received. We have interest received. So we had like, extra cash and we lend it to someone and now they pay us interest. So that's interest received. Dividend received. Dividend received are you as a business, you invested in shares of another company and now you're getting dividends on that on those shares. Okay. That's dividend received. Discount received is also an income. And then we have a thing. Okay, we'll talk about that later. So it means, interest paid is an expense, interest received is an income. Rent paid is an expense, rent received is an income. Rent paid is for the premises that we got on rent and we are paying rent for that. Rent received is for the premises that we own and we rent it out to someone else. Then we have discount allowed. Discount allow means, this is the discount that we are giving to our customers. That's an expense. Okay. So yeah, so that's the story of expenses and income. Let me just quickly show you how income statement looks like. So we have sales and we have other income. Okay. Like, all the other incomes that we are receiving from other sources. So we add them and all the expenses we subtract from it and we get to the profit. Obviously, we have got a very detailed format for our income statement. We have something called gross profit, and we are going to talk about everything in detail. But here, our point is that income increases our profit. Income has an increasing effect on our profit, and expenses has a decreasing effect on our profit. Okay, so, okay, let's have a look at an example. Some of the entries, we know that, the first entry is started in business with 10,000 in the bank. So bank debit, capital credit. Purchase goods 290 on credit from D. James. So purchase is debit and D. James credit. Bought fixtures and fittings, paying by check. So fixtures and fittings are asset. So fixtures and fitting debit and check, bank credit. Okay. Sold goods for cash, sales credit, cash debit. Bought goods on credit, so purchases debit, and C Monte, which is a liability, that would be credit. Now, look at this entry. Paid rent by cash. Rent is an expense, so debit rent, 200, and credit cash, because we're paying it by cash, and cash is decreasing, so that would be credit. Bought stationery, 45, paying in cash. So stationery, we also consider is it as an expense. So debit stationery. Someone may argue that stationery is an asset, but that's like so small an asset that we don't book it as an asset. We just consider it as an expense. So stationery debit and cash credit. Then we have goods returned to D. James. So purchase return credit and D. James debit. Purchase return credit because our stock was decreasing, and D. James debit because our liability is decreasing. Okay, so we return some of the goods to D. James. Now we are not going to pay him for the goods that we returned, so our liability is decreasing. Received rent 25 by check for sublet of a corner space. So we had a corner space and we rented it out. Now we are receiving rent on that. Okay, so that's going to be rent received. Rent received is an income. So rent received credit 25. And because we are receiving that money through bank, so we debit bank. Bank is increasing, bank is an asset, so that's debit. Sold goods on credit, sales credit, and G cross debit, because G cross is becoming our asset now. Okay, these are receivable. Bought a van, paying by check. Again, we are buying an asset. We are not buying goods. So van account would be debit. Okay, and bank account would be credit. Paid the month's wages by cash. Wages is an expense. So debit wages. When expense increases, we debit it. And because we paid by cash, credit cash. The proprietor took cash for his own personal use. Proprietor means the owner. So the owner takes money out for their own business or for their own personal use. We call it drawings. And drawings are always debit. Okay. So we debit drawings. 80. And we credit cash. Cash is decreasing. Okay. All right. Let me upload some questions for your homework. Okay, so this question you have to do for homework. Thank you. See you later.